investment opportunities are the alternative financial instruments that can be used in addition to the stocks, bonds that we've been looking at, and also the what you call alternative investments and financial instruments known to be very also very profitable. But also investors will be looking at how investors can be risk averse or even behavioral finance as relating to investments in these alternative investments and financial instruments. So, what constitutes such investments? We have, for example, hedge funds. We also have private equity, as I even introduced yesterday. We also have rates. We also have even commodity investments in commodities that are, for example, gold backed or oil backed, things like that. Yes. So, starting on hedge funds, basically, a hedge fund is a pool of investments, especially when investors diverse their, for example, their form of investments or strategies, so that they can get a return. And now for the hedge fund manager or the head of hedge fund company to generate investments for the investors that pool their funds with them. So a hedge fund can be a company or it can be a platform, okay, that encourage investors to pool their funds, especially investment funds, so that they can diversify these funds or these investments on behalf of the hedge fund holders, so that they can generate good profits and returns for the hedge fund holders or investors. And what are some of the obviously the diversification instruments that they can use? Obviously, we have equities. They can invest in shares and stocks. They can also fixed income, the fixed income investments that we've been talking about. That's bonds. Okay, they can also invest diverse into derivatives that we talked about yesterday, and even commodities. That is also another alternative form of investments and financial instruments. So commodities like gold and oil can also be uh, another financial instruments that hedge fund managers can use to diversify the investments or the funds of those who hold the funds with them. Okay. So somebody might ask, what's the difference between, for example, a mutual fund and a hedge fund? You find that hedge funds, they are only for some particular type of investors. Okay, they're not for everyone. While in mutual funds, every investor is open to all investors. Okay, but with the hedge fund, it's only a particular class of investors that can pull their investments into a hedge fund. Okay, and you can even they can even do things like leverage. Okay, and even short selling. I know you know what the leveraging, I mean, debt and also short selling is. Okay. Secondly, as we said before, rates, real estate, through rates, real estate investment trust. Okay, it's basically investing in real estate without actually owning a property. And these just a minute. These are usually where you can even own a physical property. Okay, through, for example, residentials, commercial properties, okay, things like that. Or you can invest through such trusts or the rates. Okay, it's basically, it will allow you to own the to actually own or invest in real estate without actually owning any real estate yourself. Okay, now that's its goodness or its benefits. Okay. And lastly, we talked about private equity. We've talked about a lot about it. It's basically investing in private companies, especially companies that are about to go public or are venture capitalists. Okay, so investing in companies that, for example, wants to grow or that wants to go public through an IPO. Okay, and usually you find that they have very good returns. Okay, but obviously, since you are investing mostly in startups, also the risk involved there is also massive. So, for example, some of the even the biggest even what are they called? Some of the biggest hedge funds in the world. Okay, there is one called Bridgewater Associates. I don't know if you've ever heard of it. I came about it in some article. I saw a Financial Times article about it. Okay, it's a some American hedge fund. Okay, known it's known for having, for example, some it's a home to some of the biggest investors in USA and even in the world. Okay, so you find that, for example, such a hedge funds and any other hedge funds, they normally invest, for example, as I said before, they invest in bonds, they can invest even in currencies. Okay, they can invest, as I said, also in commodities, gold and oil. They can invest in equity stocks and shares. Okay, they can even invest in interest rate, things like that. Uh, they invest based on, for example, the possibility of some interest rates rising or falling in a country. Okay, so you find that the main what they normally do on behalf of the investor that hedge their funds with them is they can try to diversify their investments at the same time by balancing or minimizing risk exposure of those investments and the wealth of the investors, as opposed to the investors allocating all their capital in one in one form of investment. So that's the goodness with, for example, investing in a hedge fund. Okay, your investments are diversified and your risk exposure, overall risk exposure is reduced. Okay, so as I said, they normally just do diversification where they, for example, invest in a wide array or variety of assets from bonds to commodities. Okay, and even they so now at the same time they minimize the risk by using the different hedging instruments also. So you find that, for example, how does now this alternative, such an alternative investment or alternative form of investments and financial instrument, how does it work basically? To be able to maximize return through diversification, but also minimizing the risk exposure of the investors. Okay, they basically lower the correlation of the investments that they invest in. Okay, they make sure to invest in assets or instruments that are loosely correlated. Okay, or asset classes that may not correlate with one another or with the traditional, for example, the highly risky stocks and bonds. Okay, for example, you can find they invest in commodities like gold and oil are usually loosely correlated with, for example, stocks. So should there be, for example, fluctuations in the stock prices in the country, then your investments are, or the risk exposure is hedged and is mitigated. But at the same time, they do risk mitigation, as I said. For example, they spread risk. You find that once they diversify across the different investments and financial instruments, therefore even the risk that is suffered by each is mitigated or is hedged against. Okay, so that's one of the big properties and goodness or advantages of investing, for example, in such alternative investment strategies such as hedge funds, rates, and also commodity investing in commodities. Next, let's look at now. Well, that's now, for example, focusing on a hedge fund. Also, rates are known to be very good forms of investments because it basically allows you to invest in real estate without uh, without necessarily or without having to own any property or any real estate property itself. Okay, uh, so let's say you you have an example. I want us to do just a quick example, for example, of why investing, for example, in commodity, even a real world example, a real life example. You find that the gold, for example, commodities are gold, or the investments that are gold but are usually known to have very loose correlation with the, just a minute, with the traditional forms So even in case of such risks such as inflation risks, such as interest rate risk and currency risks, okay, even the risk exposure is minimized, okay, and therefore that's how diversification in such alternative forms of investments work. And you find that even investing in such market crashes, market downtimes, they're usually known to be very stable even during, for example, the 2008 financial crisis. You find that the price of gold is very very stable. The price of commodities is very very stable, and it's known. I mean, it's known world over that. For example, some commodities like oil are the basis of even inflation and the prices of even all other goods in an economy. For example, in Kenya, you find that the prices of almost all goods and services, especially, are pegged on the oil prices. Okay, let's continue. So I hope we can see where we are. We have talked about investing in commodities, gold, oil, and even in agricultural produce. That's one. Even things like wheat is also a very very common other commodity that can be invested in besides gold and oil. Okay, we have looked at how, for example, we can use inflation hedges as another form of investments and also as a form of portfolio diversification and risk mitigations. Okay, now then let's look at now how cryptocurrencies and the emerging concept of blockchain in especially in modern portfolios. Cryptocurrency. I hope you know it's all based on the blockchain technology, which is basically a decentralized exchange form of exchange that offers security, for example, using the blockchain technology. Okay, which makes transactions anonymous and also secure. Okay, there are various, it's basically just a ledger. Okay, there are various forms of cryptocurrencies that come out that emerging, things like Bitcoin, popular right now, even due to its price bubble. Elections has really surged due to speculation, okay, due to the policies, cryptocurrency policies in the USA, especially relating to political policies. Okay, so Bitcoin, you find that they are well, they can also be thought to be alternative forms of investments alongside the commodities, rates, and also hedge funds. But here there are also an emerging concepts in investments and in portfolio in capital markets. Okay, and you find that many investors, especially even, for example, if we were to talk of Bitcoin, whose price has really surged since the recent US elections, you find as many investors speculate that they will get high returns, and so they diversify in such forms of investment such as cryptocurrencies. Okay, it's basically so you find that well they are changing how, for example, even capital markets operate, the forms of investments and even the financial instruments that are traded in capital markets. You find that most are actually lately try to incorporate the blockchain technology, for example, in their capital markets, and also even in investments, and also forming forecasting things like that. Okay, but as we know, a risk, there are usually also risk that is carried with them. Okay, their volatility is very very high, just as, I mean, as it is even in real life right now. The volatility of the prices of Bitcoin may change even daily. Okay, okay, so the volatility is also a concept that investors, potential investors, and speculators may need to know. So then, so as an investor, what will you do? For example, among all these types of alternative investments, okay, you can diversify between, for example, investing in commodities, investing in rates, also, or investing in cryptocurrencies such as Bitcoin. Okay, And you find that when you invest in such alternative forms of investments, including the emerging concepts of cryptocurrencies, then these alternative forms of investments are known to be loosely correlated with the traditional forms of investment, stocks and bonds that are usually carry high risk, and therefore in that case you will have diversified and also uh, mitigated risk exposure to your investments and portfolio. Okay. But as we said, I have to add a rejoinder or a disclaimer. The volatility and also risk that is carried is also a factor that a potential investor or an investor in such alternative forms of investments needs to be needs to be aware about. Okay, let's now look at how we can. We've talked about diversification as a form of diversification using alternative form of investments. So, for example, let's even talk about the recent Bitcoin. Okay, just a minute. Bitcoin apparently its price is already, is it past 90 90, is it 90,000? So that's a volatility that's very very interesting. Okay, they're very volatile, especially the prices of cryptocurrencies. Okay, and that they can gain uh, their prices. For example, they can even gain 50%, while in a typical market, even stocks can gain even just a few percentage points in their prices. Okay, so while their prices are can be glamorous, they also carry high risk of volatility. So, what is the benefits of diversifying or investing in such alternative investments? I have alluded to it. Okay, you know what diversification is? Basically, spreading your portfolio or investments across different assets and financial instruments, especially to and also during risk mitigation. Okay, you can do it to as a form of risk mitigation and also with the aim of risk mitigation. So yes, diversification can also act as a means and also an end. Okay, in that regard. Okay, we have talked about all of them. Hedge funds. Just a quick recap I'm doing. Okay, hedge funds, private equity, commodities, and also the emerging concepts of cryptocurrencies. Okay, okay. I want us to look at a typical example. Let me try to present. Just give it a second. It loads. I'm trying to present this tab. Mhm. Let me see if I can access the notes that we've been using. See the Zoom functionality that I'll be able to. That's what I'm trying to set up. I don't think it's also available in the desktop file. I'm using my laptop. I think it's only in the mobile version, but otherwise I'll get you notes with all these concepts, especially on the alternative forms of investments and financial instruments. Meanwhile, we can proceed to now behavioral finance. Okay. As I told you, most of these concepts we've been talking all about them during the course of our training. Okay, let's proceed. Now, behavioral finance. What's even it? Okay. Behavioral finance basically you it basically sees how, for example, psychology and how an investor would bring psychology, okay, into, or you would use their forms, for example, things like how they feel about a particular investments, okay, or how they speculate about a particular forms of investments into making now a decision on which, for example, which financial instruments to invest in, or which capital markets instruments to invest in, okay, rather than where you traditionally look at objectively, for example, do a fundamental or a technical analysis. Now this will now even bring in the concepts of speculation, okay. So that's all about behavioral finance. Okay, that's what behavioral finance. How you bring in the concepts of speculation and also psychology into influencing you to decide which financial instruments to invest in. Okay, especially when you are invest or when you want to diversify your investments portfolios. Okay, and it's basically where, for example, now this is where human error and operational risks may come from, and where, for example, in calculation, for example, of the portfolio at VAR, we incorporate the factor of the Z score, the confidence level. Okay, so you find that in behavioral finance and market psychology, you can be at a confidence level, you can be confident that a particular currency will appreciate against another currency. So you will be attempted, or you will speculate in that case, and you will be tempted to hold a long position in that currency that will appreciate in order to make profit. Okay, but as we know that there are usually risks associated to that. Okay, and therefore that's even how we arrive at calculation of the portfolio VAR. Okay, you find that you can be overconfident, okay, of a particular, because let's say due to the historical volatility, it's always been known that the USD will usually appreciate against the Kenya shilling. Therefore, you can be overconfident that the USD, and you can speculate that the USD will appreciate against the Kenya shilling. Therefore, you may be attempted to even be be enticed by the possibility of high future returns, and therefore to hold a long position in, for example, in such currencies, okay, or any forms of investments for that matter. Okay, you can be speculating, for example, that the stock prices will rise, and therefore to buy more, or the bond prices will rise, or the bond coupon rates will rise, and therefore to, okay. And also that also can bring in the concepts of anchoring basically, where you may rely on your traditional methods of, for example, of investment analysis, rather than looking at the prevailing market conditions. So as an investor, you need to be objective enough to know when to not be overconfident, because being overconfident, especially in making in behavioral finance, in making investment decisions, can be a bias. Okay, so you need to critically analyze the prevailing market conditions and not rely too much heavily on your overconfidence. Okay, and also, for example, on your traditional investments forms. Okay, and that can also even at the same time bring out the concepts of the different types of investors. Okay, we have investors who are risk averse or loss averse. Okay, they focus too much on not losing. Okay, rather than they appreciate an opportunity to make returns. Okay, so you find that, for example, when an investor holds also a portfolio of assets. Okay, they may, even when their psychology or when their confidence tells them that the stock prices may fall, that they may still tend to hold on to these assets because they are confident, okay, that these prices won't fall, and therefore they, they in that case we'll call them loss averse. They don't want to make losses, but at the same time they want to make gains, or they want high rates of returns on their investments. Okay, that can also even bring out another concept of herding behavior. I think that we all know about, where investors tends to follow the crowd. Okay, the crowd factor, in especially to buy particular shares, they tend to follow the crowd. For example, when the prices rise, that's where they tend to buy. When the prices fall, then they sell. Even when it's just purely and the best financial decision. Okay, so things like, so now overconfidence is a bias. Okay, relying too much for example, on a single piece of information or on a single source of financial data may not be the best form of investments and behavioral finance. Some investors may also be loss averse and risk averse. That can also be a bias, or following the crowd. Okay, for example, just to give even a critical real life example, during the 2008 financial crisis, many they feared that they, they'd realize massive losses if they sold. Okay, even though in real terms it would have been better to sell, because the I mean the prices kept on falling and the market kept on crashing. So had they even sold earlier, and then they would have at least not made as much losses as they did. That would be a bias, and that also brings up the concept of behavioral finance in their investments and decision making. Okay, had they even sold their assets and also diversified into more stable investment strategies and also instruments like commodities, or that are loosely related or correlated to those that were under risk during the 2008 financial crisis, then they might not have made as much losses. Okay, let's say an investor is trying to, just a minute, an investor wants to buy maybe Safaricom shares. Okay, because or let's say they want to, let's use Bitcoin that's currently rising. Okay, you as an investor, you want to buy Bitcoin. Okay, because for the past was it 2 or 1 month, 2 weeks or 1 month. Okay, the prices of Bitcoin has been rising. Okay, but at the same time, we know it may be just a bubble, and it might crash. It might crash because such cryptocurrencies usually are very, very highly volatile. Okay, so that may bring out their behavioral finance biases in the form that they may be following the herd. Okay, and that herd behavior is now even what is driving the prices of Bitcoin even higher further. Okay, it's basically even just speculative and hiding behavior. Okay, and I think I read in the, was it Bloomberg or Forbes? Okay, that's how actually even how the dot-com bubble started. You know about all about the dot-com bubble. Basically, how during the tech revolution around the early 2000s, okay, people really speculated that the next big thing would be technology, and it was, yes. For example, things like social media, technology, internet. Okay, people speculated, and people, you find that bought a lot of shares in such tech companies. Okay, and that kept on even driving the prices of such, I mean, tech companies and tech products even further, more than even what it in real times actually was worth. Okay, you find that the price that the hiding behavior has driven Bitcoin to be what today may not actually be the price that it is really worth if you even were to use the investments, the traditional investment strategies, or even calculating the intrinsic value of such an investment. Okay, so you find that such hiding of behavior, okay, will, it may lead to, for example, a bubble, what we call a bubble. Okay, and therefore at the same time driving the prices of that asset even higher and higher beyond even its worthwhile price. Okay, and therefore, well, so in the case where you want to, because I mean, Bitcoin has been rising over the past 1 month, therefore you want also to invest in Bitcoin, because well, it may crash, so it can also bring out the concept of herding behavior, where you are just following the crowd that says or are confident or are speculative that Bitcoin, and are responsible for even driving the prices of Bitcoin further. But at the same time, there can also be risks involved. Since as I said before, such cryptocurrencies are really, their prices are very highly volatile. So what can you as an investor do? Okay, for example, a risk averse investor, you should evaluate the price or the worth of that such an investor investments. You should do proper fundamental and technical analysis to be able to know what forms of alternative investments to invest in. Okay, and not depict or not give off the different behavioral finance biases that we talked about, adding behavior and things like that. Okay, so we have talked about, for example, the biases in, especially in behavioral finance. I hope you can see where we are. Okay, we've talked about the psychology of investing, especially based on emotions and speculation. Okay, how it influences and informs investments decision making. Okay, overconfidence, we've talked about overconfidence and hard behavior, and how it impact, for example, investments decision to invest in what financial instruments and not which one. Okay, we've also seen about how, so now we are here. Now let's see how, for example, how behavioral finance impacts market trends. Okay, so therefore you find that I haven't alluded to it. Okay, you find that it's such behavioral finance biases, eh, that even inform the market trend. For example, in the capital market trends, or Bitcoin or cryptocurrency market trends, things like that. Okay, stock market trends. It's all due to speculation and behavioral finance, basically, and the biases that we just talked about. They say investments even in the capital markets, or in any kind of, in almost all the forms of capital markets, it's all just behavioral finance, especially overconfidence and speculation. Okay, you invest in Safaricom shares with just the speculation that, or or even you have a bias or the perception, what we call now the behavioral finance, your behavior, your perception, or your speculation of Safaricom to be a good company, okay, due to its innovation, due to its recent, for example, financial disclosures. Okay, Therefore, you speculate that their share price will rise, and therefore you invest more on it. So in that case, your speculation and your overconfidence, okay, will inform what we generally call the behavioral finance and biases in behavioral finance will impact, for example, the trends in the Safaricom shares and stock market trends. Okay, and as I alluded to earlier, this is exactly how, for example, the dot-com bubble and any other, for example, what is generally called market bubble occurs. That's it's all due to and it's all due to behavioral finance, overconfidence, and also the biases. But just as it can lead to, for example, a market bubble, and for example, the dot-com bubble, it can also lead to a market downturn, right? It can also lead at the same time, and in the same way, it can also lead to market crash due to speculation. Okay. Uh, for example, that's how even bank run. I hope you know what bank run is. Okay, basically when there is a surge in withdrawals. Okay, that's why customer service and behavioral finance in banking is very very sensitive these days, or what some people may call customer trust. Okay, especially in banking, it's a very especially with the advent of social media, it's a very very sensitive concept. Okay, it can lead just as it can lead to market bubble, as we are witnessing with the Bitcoin, and we witnessed around 2000s with investments in Apple, in Facebook, things like that, and those tech companies, what is normally called the dot-com bubble. It can also lead to, for example, the 28 financial crisis and other market crashes, instances of market crashes and market downtimes, right? For example, what caused the 28 financial crisis? It's basically when investors or customers start to panic, okay, and they withdraw their forms of investments, or they withdraw their assets. If they have shares, they sell their shares. Okay, even when that may purely be biased, and then it may lead to, even so now, it may lead to a ripple effect, even leading to an entire financial crisis in a country, or even worse, bank run. Okay, that's how bank runs. Okay, okay. You know about the Kenyan bank that collapsed due to investor panic, okay, or customers panicking. Okay, for example, one customer, and that's why I brought up about the fact that investor confidence, especially in banks or customer service, a very sensitive issue. You find that when one customer, for example, is unable to, or when the bank is unable to meet, let's say, a surge in withdrawal by a customer, or even one customer, and then due to social media, that can spread, okay, throughout the market or throughout the banking industry, and then that can lead to market panic. Customers will panic that are their funds or are their investments safe with such a bank or with such a company, okay, and then therefore they can withdraw their savings, they can withdraw their cash and assets, and also if they hold the assets in that bank, they can sell their assets, and therefore leading to even the collapse of an entire bank. So that's how even behavioral finance and also the behavioral finance biases can lead to a market bubble or a market crash. Okay. Another form of even bubble, even, for example, there was a housing bubble also in the United States around around 2010. Okay, to 08, to just before 28. Okay, in 28 there was a financial crisis. Just before it was preceded by the housing bubble. Okay, we find that people are exhibiting the different investor behavior and behavioral finance biases. For example, just following the hard what we call hard behavior. Okay, there is a general, for example, of a confidence by investors or potential investors in the economy, for example, in the housing market, for example, in this case, the USA, and therefore it leads to herding behavior, okay, and therefore even overconfidence because you are overconfident that, for example, the housing and the real estate market in the economy will rise, and therefore it can even lead to a bubble. A bubble is basically where the real value of a thing is exaggerated beyond its actual true value. Okay, you find that a company that can you give me maybe an example of a company that you feel you feel is undergoing or its prices is due to just a bubble. Okay, Bitcoin and also Nvidia stock prices. I mean, it's also another form of tech bubble or dot-com bubble. Okay, overconfidence. I mean, it may even exaggerate the entire, for example, stock price of a company. Okay, so yeah, we have talked about how, for example, the investor behavior and behavioral finance biases can lead to not only a bubble, but at the same time, it can lead to a market crash or bank runs, things like that, especially overconfidence and herding behavior, generally following the mass. Okay, and we have seen how in each case it can lead about. For example, in a market crash, it can lead to, for example, when there is a bubble, and then when there is a when investor loses their confidence in, for example, in a particular company, and then it can lead to all the investors or many investors withdrawing their assets or investments, and therefore leading to the collapse of such a company or even of the entire market. Okay, then therefore, what can, for example, a potential investor or a potential capital markets and investments manager do? What can they do to in the form of in the process of investing? They need to be they need to be aware of, for example, to not fall to these biases, for example, overconfidence and also overconfidence and hurrying behavior. You as an investor needs to be mindful of that. You need to recognize and also be aware of the, for example, the overconfidence bias and also adding behavior bias, so that at the same time you are making an investment decision, you can minimize or mitigate the risk that can befall you if you were to fall to that bias. Okay, because if you were to fall, for example, to the bias of overconfidence and invest in a company that its its true price is exaggerated, then you can suffer some of the risks, for example, interest rate risks and also even credit risks. Okay, also you need to do, for example, I just talked about this a few minutes ago. You need to do thorough analysis, both fundamental and technical analysis. For example, follow the normal investments analysis process. For example, keenly calculate and be mindful of the, for example, the price per earnings ratio of a company before committing your investments. Okay, you can research the market data of such company due to, for example, their recent financial closures. Okay, and don't act with too much emotion. Okay, but also that's where now financial advisors like you and I come in to help, for example, manage some of these biases such as bubbles and, okay, and investor loss of investor confidence. Okay, so for example, you as an investor, you can set for yourself that I know that there is overconfidence in the prices of, for example, or in Bitcoin, okay, generally in the prices of Bitcoin. But you as an investor can tell yourself, okay, can be loss averse such that even if there is a bubble in the prices of Bitcoin, okay, should it pass past let's say 80, then that's where I'm drawing my I'll draw the line. That's where I'm drawing my threshold. Okay, so that you at the same time don't fall to the behavioral finance biases. Okay, so that's how you can basically develop a bias reduction strategy, especially if you are investing. Okay, or you can use things like that's one way. You can even use stop loss orders to avoid you holding on to too much investments that are losing for too long. Okay, for example, in during the 2008 financial crisis, okay, people are knowing that there is continuous fall of, for example, the stock prices, okay, but are fearing liquidating due to fear of losing, okay. But what they should know that the much they continue holding, the much that it will continue falling, and therefore even their losses will be even high. Therefore, they can use a stop loss order mechanism to determine, for example, that it should it fall past a certain price, then that's where I'll draw the line and exit, or cash out. Okay. Therefore, in that way, you will have reduced, for example, falling into the bias of overconfidence, and also loss aversion. Okay, which is, loss aversion is in itself, as I said, a form of bias. Where, just to repeat it and to recap, where you fear losing, that you keep on losing, basically. Okay, they say when you realize that you are going the wrong way, the best thing to do is to not continue, but to make a U-turn. But so now, in investment terms, you may fear losing. Okay, you may know that if you should you cash out at that particular point, then you'll make losses without realizing. Should you hold even much longer, okay, you will continue. Your loss will be even greater. So it's usually even better to minimize your losses. Well, you lose all the same, but at least you will have minimized your losses. Okay, and we've talked about how, for example, that led to even the market bubbles, both the market bubbles and also the market crashes. Okay, I basically now know as it equips us as investors and also investment managers to know how behavioral finance and psychology affects, for example, impact, for example, investments by investors in capital markets, and also even in general, other forms of markets, even in the alternative investment markets, such as the recent cryptocurrency bubble. Okay. Just a minute. Somebody's calling me. Let me just decline it real quick. Okay. So we've talked about now, for example, strategies for managing cognitive biases. We have talked about the biases and how to manage, for example, those biases, especially in making investments decisions. Okay, on what to invest in to avoid falling even into overconfidence, and also falling into herding behavior that has led to market crashes. Okay. Okay. For example, another example that I might give that I was forgetting, let's say the stock prices not only rises, let's say not only in one company, but even in an entire industry. For example, in the entire tech industry, but I've provided a similar example. Even in the entire tech industry, as it were in the dot-com bubble, okay, you find that a group of investors might be exhibiting overconfidence and also herding behavior, okay, and causing, for example, that entire market, in this case, the entire tech market, tech industry, to the prices, for example, of companies in the tech industry or assets, tech assets, to be overestimated or overinflated. Okay, we talked about that. So behavioral finance, just to provide a quick recap, behavioral finance will help you as an investment manager or a capital markets analyst, okay, to be able to understand the psychological and financial biases, okay, that investors make, especially when choosing or deciding on an investment decision, okay. And so yeah, now in that case, you'll be able to know why some investors are risk averse, loss averse, things like that. So, and also those biases, investment biases, and also behavioral finance biases, uh, as we talked about, overconfidence, loss aversion, and also the herding behavior, will now determine, for example, how such investors, okay, will make their investment decision. You as an investor will now understand why, for example, there is a Bitcoin bubble, cryptocurrency bubble, okay. Why, for example, there is overconfidence in a particular industry, for example, the tech industry. You saw for example, the perpetual increase in the shares of Nvidia, okay. So you can understand why that even happens, okay, and therefore understand why that happens, then therefore you can design your own investment mitigation and risk mitigation strategies to be able to not fall victim to such biases, okay. You can tell yourself that I know, as I just to repeat, I know that the Bitcoin, there is overconfidence, that there is speculation in that market, okay, but should it bubble past, let's say, 80, then that's where I'll draw the line, okay. And therefore you can decide in which investments and also in which even industries to invest, and in wisely, and by how much, okay. So yes, that's all about behavioral finance. I hope you can see we have talked about even the dot-com bubble. I tried to highlight it, how it all came about, okay. What started it all, for example, and also the 2008 financial crisis, okay. Next, let's look at now financial regulations and ethical considerations. Okay, we'll now look at now, for example, the regulators in the finance industry and ethics, basically how all that regulations and ethics are related to, for example, financial and capital markets. That will be our very very last module. Okay, we find that regulators and regulations, especially from the basic and from the local capital markets in Kenya, for example, the Capital Markets Authority, to the banking regulator, and industry regulator, Central Bank of Kenya, to even global regulators, for example, in the USA, the SEC that recently flagged Adani, okay, the security is called ACC, the Securities and Exchange Commission. It's also the regulator of, for example, the Nasdaq and the NYSE, okay. You find that they regulate, those are regulators, for example, in the stock exchanges, and also the entire capital markets and also investment markets, okay. So there are a whole lot of regulators, especially in capital markets, in investments, in finance, in banking, and I know we almost even know all of them. For example, even other financial and accounting, for example, and also even banking standards. For example, the Basel III framework. I hope you know even the Basel III framework uh, that informs or stipulates the capital adequacy requirements for banks. For example, that they are needed to maintain, for example, at least 4.5% of their risk-weighted assets in the form of CT1, that is the common equity one, the first round of funding that banks, not only banks but also even most corporates raise. Okay, There can also even be financial and capital markets and industry, banking, even banking and accounting industry, financial standards, for example, such as IFRS, okay, that is the international financial reporting standards, okay. Then can also, for example, the regulator, global regulator, or for example, the banking industry, or I mean the financial industry in the world. It's called FINRA, the Financial Industry Regulation Authority. It's based in the USA. There are a whole lot of the other regulators, okay. And what they have highlighted, what they mostly do, for example, the Basel III, what they stipulate, okay, the IFRS, for example, the International Financial Reporting, that requires or stipulates that banks and most companies that are listed, that are required to make regular financial disclosures. Therefore, what's the aim of that? To protect, especially they protect, for example, consumers, savers, and even just generally investors in capital markets and financial markets, okay, against, for example, unfair practices, or even against unfavorable stability or volatility, for example, in such capital markets and financial markets. And at the same time, even you find at the same time, while they exercise these standards, okay, for example, to protect the investors, okay, and also, for example, such financial reporting standards that are maintained also will lead to, for example, investors, for example, in the banking or financial markets, to be protected against, for example, against the companies, for example, manipulating the prices of shares, what's usually called market manipulation. Companies may overprice, for example, their bonds, okay. Uh, they may, for example, overprice, they may manipulate the prices of their stock, okay. So such regulators come into, for example, to protect the consumers and investors, especially in capital markets, against such manipulations, okay. It can also even be it's fraudulent even to do that, okay. It's fraudulent for banks and even other listed companies to do market manipulation, and even engage in things like insider trading. Okay, yeah. So it can be fraudulent due to the regulations by such regulators and such standards. Therefore, consumers and investors in capital markets are able to be protected against manipulation and fraud. Okay. And even the aside other regulations and also reporting standards such as the phrase, generally it's just to maintain, for example, transparency in the disclosures, for example, to main, to ensure that, for example, companies that are sensitive, such as banks, that are very sensitive in the economy, that they are transparent, for example, in their financial disclosures, because otherwise banks may overestimate, may overreport their financial health. Okay, they may overreport, or they may manipulate, for example, their part, okay, their NPL, okay, and when that's even why that's the provisions for bad or under NPL, non-performing loans regulation. That's where it comes from. Okay, so some banks or some companies may manipulate that. So such regulations and such regulators and such financial reporting standards and other standards and industry standard all come in to prevent, for example, to promote transparency, especially in the financial disclosures of players in the financial and capital markets. Okay. So we now have talked about almost some of the non-industry regulators, SEC, the Securities Exchange Commission, FINRA, the financial the financial regulatory Financial Industry Regulatory Authority, the MiFID, that is the Markets in Financial Instruments Directive, okay, and IFRIS, and all other regulators that are all players in the global capital markets and even investments markets. Locally, I've talked about how we have even the Capital Markets Authority, even the CMA, that's the or the CAK, Competition Authority of Kenya, is also at the same time a regulator in the capital markets in Kenya. Next, let's look at now the ethical factors especially in capital markets, the ethical factors in capital markets. We find that ethical, I think I've alluded a little bit of this. I've alluded to this a little bit. We've said, for example, it just promotes common decency and transparency. For example, in the disclosures of listed companies and of their financial disclosures, the quarterly disclosures, for example, of their profit after tax, their NPLs, okay, especially in banking, okay. So that is to provide just so that consumers are protected against market manipulation. Because let's say a sensitive industry like banking, okay, a bank manipulated their financial health, and it led to collapse of that bank. Then that can lead to even the entire market crash and even mismatches and also problems and crashes in the banking industry. So basically, ethics in financial markets and also in capital markets and in investments provides and also promotes basically confidence and also transparency and also trust between investors and also investors and also players, these firms that are players in the capital and investments market. For example, it will prevent unfair practices such as insider trading, market manipulation, where some firms may overprice their. I'm talking a lot. My mouth tends to get dry, so I keep drinking water. Okay, what was I talking about? So you find that investors may lose confidence in such funds when they overprice or when they overspend their share. So it's common practice for there to be transparency, for example, in the disclosures of such funds, so that such a if there is a potential investor, okay, they can critically analyze, for example, the financial disclosures of such a firm before making a decision whether to invest in, for example, the shares of that firm. And that even can also even come to even in during debt issuance and also leverage. Okay, as we said, corporate, especially corporate debt insurance. What am I talking? Corporate debt in the form of corporate bonds. Okay, we know that corporate bonds depend on the credit rating of such companies that are issuing the bonds. So if there is if there isn't in trust and transparency, for example, in the credit rating and also in the general financial health of of this company that is issuing the bond, then it can lead to an investor investing in a bond that is riskier than they should invest in. So basically, so those are some of the ethical consideration or ethics and things in financial and capital markets. There should be transparency, especially in reporting in the regular financial disclosures. Okay, there should be, for example, things like uh, insider trading. Okay, and that's where even such factors like the EMH, the efficient market hypothesis, comes from that. The shares, the share prices in a capital markets should be representative of all the industry and the market knowledge and information and data available. Okay, there shouldn't be insider trading. So you find that the market prices and the stock prices are a true reflection of all available data, such that should you be an investor who wants to invest shares or stocks of a particular company, you are able to analyze such, for example, such market data and financial data and disclosures, past disclosures relating to that company before making an informed decision whether to invest in those shares or not. Okay, and that in that way it will it will promote transparency, promote insider, prevent insider trading, and also even it's just even prevent fraud. Okay, that's even why public companies, especially listed companies, are required by law, okay, by the CBK, by the CMA, and other regulators, and even internationally, okay, to periodically, even quarterly or monthly, to publish even in newspapers. As so serious that they are required to publish this for example, national newspaper, okay, to publish, for example, their quarterly balance sheets. All right, things like when they announce, for example, change in their board or directors, okay, change in management, they are also required to announce this, okay, when they are selling the company, or when they have maybe acquired another company, or merging with another company. There should be transparency in all these processes, and they should disclose, because those are very, very information that are of interest to a potential and even existing shareholders and investors in the shares of that company, not only that company, but also even in that whole industry of capital markets. Okay, so when, for example, there is a company that is let's say KCB Bank is merging with, or let's say National Bank of Kenya is being sold by KCB to Access Bank. So now, if you are an investor in the shares of National Bank or KCB Bank for that matter, then you can see is the new Access Bank, where you'll now be technically an investor in worthwhile your investments. Okay, when they are, for example, the CEO is stepping down, is the new CEO a better? Okay, will they lead the company to profits and growth, and therefore your investments will be safe or not? Okay, so that's all the principle. That's the essence of the principles of ethics and transparency, especially among the players, investors, and also the companies, especially public companies in an atypical capital markets, even in Kenya and even globally. Also, as we said, it prevents fraud, and prevents things like fraudulent insider trading, and generally fairness, because when, for example, when listed companies do not publish their financial disclosures in media and in newspapers that are national, that can be accessed by anyone, then in that case, some people will be unfairly disadvantaged. Okay, they will know some insider information that others do not. That's why, so it's a requirement, okay, for such listed companies to publish, for example, and disclose their financial information, their statements of their financial position periodically in most of the accessible for media and forms of information, social media. These days, they are even required to even publish on their social media. Especially, for example, if you find there is a board of directors change, they tend to also even advertise that. Okay, so in that way, it will promote fairness, but also prevent fraud, insider trading, prevent even market manipulation. So you mean, if you are required to periodically disclose your financials, then you can not easily even manipulate your financial health as a company, as a public company. You may not easily engage in fraudulent insider trading. Okay, that's why all information that is that is that is available to the public should be available fairly to everyone. Okay, and also it's even in the good interest of the of even ethics. Such ethics as relating to capital markets is in the good interest of just basic good governance, for example, CSR, okay, and other good governance, and also governance standards, for example, in public companies and also in capital markets. Okay, it will ensure that there is no public company, especially this is relating to, for example, in the financial industry or banking industry, there will be no, for example, bank that are managed in a way that serve the interest of just a particular set of stakeholders or shareholders. Okay, find that such the management of such bank and the governance standards. Okay, for example, things like good governance. Okay, CSR serves the interest of the entire population or even shareholder. Okay, and that's even why most companies do CSR for a social responsibility to show that they have a good faith and they are committed towards good governance and to promote ethics in, for example, in the financial markets and also in the capital markets. Okay, and also even lately, as I was it the day before yesterday, there is the emerging concept of ESG, and that most even public companies incorporate the concepts and also the regulations of environmental, social, and the governance in their governance and also in their frameworks. Okay, so there is, for example, climate action, okay, environmental action. Okay, most companies are green lending, especially banks. You find that a typical bank may not lend to you, for example, if you are going to use those loans to, for example, to finance, for example, environmental degradation. Okay, we just we have finalized that was the last concept and financial regulations and ethics in capital markets. But yeah, we'll now see. Let's take a short break. Let's say maybe a 30-minute break. What do you think? Or how now? Once we finalize tomorrow it will just be quickly to recap the whole course. Okay, to recap the whole course because we will have now finalized our web capital markets and investment strategies training. Okay, thank you. Unless you have any questions, we can maybe take a quick break and then we come back and then I finalize on that last module. Finalize on that last module, and then that will be the end of our training. Tomorrow it will just be to just recap the whole, to summarize and recap what the whole training has been on.